I'm the senior pastor here at New Vision, and I'm so excited for what we have in store for you this afternoon. We have a home buyers workshop, and this is geared towards helping you and equipping you to take the next step in wherever your home ownership journey is. Now, to give you just a bit of context, this is New Vision International Ministries. This is our campus, this is our location, and we not only want to meet the needs of people spiritually, we want to address their holistic needs, understanding that in today's economic times, you need information, you need insight, you need quality partners to help you make decisions for your family and for your household, and we know that it's important for you to be equipped with the right information and the right knowledge. So we're bringing this workshop with a desire that each of you, regardless of where you are on your journey, you will have what you need to make good decisions. Here at New Vision, over the past month, we've been talking about economics, personal finance, and ownership. And so this is part of our effort to bring the information to you. We have an amazing partner in First County Bank, and you're going to learn more about who they are. And I want to give a special shout out to Beth, who's been our catalyst on the end with First County Bank, to help bring together this panel of experts as we talk about a variety of topics. So I want to encourage you first and foremost to breathe in and breathe out. Okay, I know it's been a full day. Those of us who came to worship, we had a full day of worship. You might be a little bit full after you ate. So we're going to pray that you can stay alert and stay focused and just really get the information. Take notes, but really listen. We're going to cover a variety of topics. We're going to touch on certain things, but hopefully you'll get what you need from this workshop. And so I just want to pray just to set the tone, and then we're going to hear from this amazing panel, and we're all going to grow and learn together. So if you don't mind, if you would allow me to pray. Lord, I thank you so much for this day. I thank you for our friends at First County Bank and all the different professionals that sit on this panel representing their areas of expertise and their various organizations. I thank you for this church and the community in which you have placed us here in Bridgeport, supporting really not just Connecticut, but places like New York, north and south, east and west, as we gather people together to equip them, to prepare them to be as strong as they can be in uncertain times. I pray that you would speak through this panel. I thank you for each and every topic. I thank you, Lord, for how you are working out in people's lives individually, in their households, in their homes. You are helping them to overcome the odds. I pray that this would be a moment of hope. I pray that for the person who felt like they could never own a home, that they would now get a plan together and know what they need to do. I pray for every person on the stage of this process that they would smile at the future and that they would rejoice in the potential of what can be, and that you would put good people and good resources around them so that they can accomplish and exceed their goals. Bless each and every person on this stage as they communicate to us. In Jesus' name we pray, amen. Beth, we kick it to you.
Okay, can you hear me? Yes. Okay, that's me, maybe 5 years ago. Anyway, I'd like to actually thank all of you for coming here to listen to our workshop, and hopefully you have some take-homes. We won't be able to go in detail, so hopefully you give us a call or ask questions at the end, and then maybe we can guide you on a one-on-one basis. I'd like to take this opportunity to thank Pastor Dexter, Paula Moody, and Shamir for helping us put this all together so that we could help you. So some of you, this is a homeowners or home buyers workshop. So usually we concentrate on first-time home buyer, investment properties, but I believe that some of you are first-time home buyers. Others maybe are downsizing, looking for another home because you're upsizing because your families have become larger, or maybe you're moving to a new community because a job or your child's school is somewhere else, or maybe you're just exploring investment properties. Hopefully, this panel that I put together will be able to guide you through that process. And thank you for actually bearing with me for a while. I was just telling Pastor Dexter, it's been 2 years. I was in remote for 2 years because of COVID. This is my first speaking event after 2 years. So thank you. It's a very kind audience, and if I fumble, I'm sure you'll forgive me, right? So let me introduce the speakers. At the end over there is the ministry's attorney, who happens to be my husband and my attorney Brucker. We have HDF, which is a big group of people that help first-time home buyers, and it's Roxana Ubelis and Kate Graveline. And very important person to know is Stephen Roberts. He's our credit specialist. So those that want to improve their credit scores, credit content, that's his expertise. And the gentleman over here, we go back 30-something years, 35 years. He wasn't a home inspector before when I met him. He was a computer guy, Bob Camarda. And I think they don't need introduction. We had 4 realtors in your ministry. We have Matthew Langston and Io Haynes, right? Thank you. And in spirit, we have Vera, who is vacationing, so we have no sympathy for her. But Rochelle actually called me early this morning. She had a terrible headache and couldn't make it, but we said we'll mention her name. So I'd like to introduce First County because First County is not known in this community, but my bank is very interested in helping the Bridgeport community or this lower area of Fairfield community. We are a bank that was actually born in Stamford, and we actually concentrated and focused on mortgages and helping people get their homes. So this is our specialty. We are a direct lender. We're not a mortgage company. We are not a correspondent lender. You're talking to the source of the money. First County Bank was founded in 1851. That makes us 171 years old. Our focus is on customer service. And I'll tell you, that's very true because I was their customer about 30 plus years ago before I started working with them. And I'm still their customer. They really have this old bank attitude where you have somebody to talk to and somebody to sit down with to actually sort out your issues. I really pride that about our bank. We believe in community support through participation. I am Miss Volunteer, and they love me for it. And it's finally, I found a home. That's where I met Bob, by the way, and that's where I met my husband, was in a non-for-profit organization. It's my life. I like volunteering. I'm very active in many communities and hopefully active again in this area. We are proud to be an environmental of inclusion and diversity, which is very true, and we are trusted advisors. We put your needs first and what helps you first before our needs. Okay, so now I put together 8 steps on home buying, whether it's a first-time home buyer, an investment property, a second home that you're going to buy. And it's attending a home buyer's workshop, so you get the terminology and the process and everything, and you're doing that right now. The second is a pre-approval process, which for me is very important, and I think for the realtors, they will agree with that. It is important before you go out there to get a very good pre-approval. Mortgage process and mortgage options. HDF and myself will talk about that. The housing search, our expert realtors are here to discuss that with you. Purchase and sale contract and closing, the attorney will talk about that. Property condition, that's his bandwagon over here. And of course, the credit will be Stevens. So the first step is really preparing yourself to buy for buying something that would be one of the biggest purchases of your life. Agree? Buying a house will be the most expensive purchase that you're ever going to make. So it's important to you to take the necessary and correct steps to do that. So what is a pre-approval? And why is it important? What is a pre-approval versus a pre-qualification? You're going to hear about that. And what does First County do to actually make it a little bit more accurate and more valid that will actually allow you to sleep well at night? Well, let me go through that. A pre-qualification is pretty much what you see online. You go online, you put in your name, you pull your own credit, you put in your income, you put in the assets that you think you have, and the computer spits out a pre-qualification. If you give that to your realtors or the seller's realtor, they're going to throw it back at you and say, get a proper pre-approval. You can get a pre-qualification also if you talk to a loan officer, because all they're going to do, because it's very tedious to do a pre-approval, is pick up the phone with you and ask you, okay, how much do you make? How much do you have in the bank? What's your credit score? And then they write you a letter. That's useless. You want a pre-approval. What a pre-approval is you're going to deliver some documentation. They're going to hard pull a credit report and your credit scores. And they're going to analyze those numbers and write you a pre-approval based on how much you can afford, how much down payment you can actually you have, because it's not just many people that come to me say, oh, I have $20,000. Well, what about your closing fees? What about the taxes that you have to pay? So these things are important to know, that it's not just a down payment that you need to actually have, but you have to have taxes. You sometimes will have to pay 6 months in advance depending on when you close. You have to pay insurance for a full year. So all of that money, that's what a pre-approval is going to do for you. And I'll go over it more in detail. What our bank does, and I think it's unique to our bank, is we actually put forward the hard work first. And what we issue is a pre-commitment without a property. A pre-commitment versus a pre-approval is an approval from the bank saying, I'm committing to you, let's say Jane Smith, to lend you $200,000. We have not only the loan officer reviewing your data, but the underwriter reviewing the whole package, verifying your income, going through the Patriot list, looking at your assets, and committing to you. You're going to carry a document that's signed by the underwriter and by the bank that we are committing to you a certain loan amount to buy this house that is only subject, this is very important, subject only to an acceptable property. That's huge. You know what that means? It's almost like you have cash in your pocket. Why? Because that loan is not going anywhere. The realtors will actually tell you many of the pre-approvals are written haphazardly, and by the time you go to the underwriter, they're going to say you're not qualified. And I inherit a lot of those clients because they're stuck. They put on the down payment. They really want this house. Please help me out of this dilemma. With our pre-commitment, the only thing that can cancel that commitment is if there is a huge financial setback in your lives. For example, you get sick, you don't have a job, you moved away, your company closed, or maybe somebody stole your identity and your credit changed. Those are the things that will cancel your pre-commitment. But it's always nice to carry that pre-commitment because it also allows you to be a stronger buyer, especially in this market. We have a ton of buyers buying the same house. So one, we have low inventory, and you probably have 10 people putting a bid. The seller is going to look at your offer, and it's going to say, oh, this is a pre-approval. This is a cash buy. This is a pre-approval, but it's a commitment. So you're going to be alongside that cash buyer. And you can also say, because I'm already pre-committed, I can close in 10 days. That's unheard of. Why? Because the only thing we need to vet right now is the property you're buying. And you're going to say, well, the property is okay. Not all properties are going to be okay. And why? Well, maybe it's a condo that's non-warrantable or a co-op that's not also acceptable. Or it's a house that has some issues, black mold, or the value didn't come up. And so therefore, when that happens, you yourself won't buy the house because the bank no lender will be able to actually lend you money. Okay. So far, we're doing good? So when you're doing a pre-approval, I put this diagram in front because it's very important to know, how do I qualify for the loan? Well, the way basic, and Kate will actually discuss this as well, is we look at your ability to pay the mortgage. Since 2008, banks are forced to lend you based on your ability to pay. That's DTI. That is the acronym for debt to income ratio. And what that totally really means is actually your total debt, if you have student loans, credit card, car loans, whatever debt obligation you have every month, over your gross monthly income. If you're W-2'd, we can use your gross monthly income. If you're part-time, most banks will require that you are in your part-time job for 2 years, and we have to average your income. If you're self-employed, again, you need to be in your self-employment for 2 years, and we average your income. That's why those pre-qualification where they don't really analyze your income is dangerous, because you may think that you made 50,000 or 60,000 last year, but the year before you made 20,000. Guess what? You're not making 50,000 because they have to average that income. Now, if you're making 50,000, 60,000 a year, 2020, and then you made 20,000 the year 2021, guess what? It's not anymore averaging. It's going to be the 20,000 because it's lowered. Okay? Any questions? Electronic disclosure seems to be the way to go nowadays, and it's actually good because it's faster. It's no longer the snail mail. In the olden days, we used to send it by FedEx. You get it, you read all this documentation. We have to mark everywhere you're going to sign. Documents are thick. Now they've streamlined this process, and everything is electronic. So it's a secure portal. You're the only one with your password and your loan officer that can actually access this. Of course, if you don't like to do electronic disclosures, you are able to request to do physical disclosures. But again, it takes time. You're not going to close in the 10-day, 15-day period. It's going to take a long time. So borrowers will need to accept or acknowledge that you are accepting electronic disclosures. You will sign most of the disclosures electronically, except for 3 forms that the banking regulators feel that you need to sign physically. There are hard copies of these disclosures, which can also be sent out to you by mail, and sending documents securely via encrypted email. So when I send you a request for documentation, I send you an encrypted email, so you send all your documents through that encrypted email to protect your identity and your very valuable information. So the loan process you've already done. The loan application is when we fill out the loan application when you do the pre-approval or the pre-qualification or whatever you call it. And it's a very thorough loan application. We will give you answers, and that during that time, you will ask or you will learn quite a few things, like, for example, mortgage options, what you can really afford, and so on and so forth, and I'll go into that in more detail. Appraisal and credit report. These are third-party fees. You need to pay this upfront through your credit card. There's no escape. You need to pay this upfront. So the average appraisal fee is actually $480. Now, I also want to stress that the bank orders the appraisal. The home inspection, your realtor will order that, or you will order that personally. There are 2 different things, and Bob will discuss that and tell you what the differences are. Okay, the credit report is also paid up front because it's a third-party fee, and it's $28 per pull per person. Appraisal is about $480 for a house that's up to $700,000. Application process, what is, again, the pre-approval process, and the underwriting and approval, that's actually when they issue a final commitment. And we can only issue, or any lender can only issue a final commitment when we get the appraisal report. Okay. Loan closing is scheduled, and that you can actually, it's usually scheduled by your closing agent or the attorney. And very important to know, that is when you have to pay attention to what they call the closing disclosure. The closing disclosure will itemize your actual costs for this loan. Initially, during a pre-approval or a initial application, the initial disclosure, which is the loan estimate, is exactly what it is, a loan estimate. In our bank, actually, our bank fee is $897, but we offset it with a $1,000 lender credit for all purchases and refinances. The only exception to this is actually if you're going for a construction loan. We don't offer the $1,000 credit. So pretty much our bank doesn't have a closing fee. You will pay your attorney fee, you will pay for the appraisal because those are not bank fees, and you will pay your prepaid items, which are the taxes, your homeowner's insurance, and prepaid item would be interest in advance. One of the things that you need to know is that when you close on a house, whether it's a refinance or a purchase, we collect in advance next month's rent. You always pay your mortgage in arrears. So you're paying in March, it's really for the month prior to that. Your April payment is really for your March payment. So you're going to skip a month. So if you close in March, you're not paying in April, you're paying May. And the loan closing, your attorney is going to tell you what to bring. Usually they'll tell you the ID and probably a check if you need to bring a check. Usually it's a bank check, but each attorney would like to have that liberty to tell you what to bring. And now it's time to enjoy your new home and your home equity loan or a refinance and sit back and enjoy your home and start doing the hard work. So required down payments. Our bank have variable down payment. I mean, of course, 20% is the required down payment, but we also take 5% down, 10% down, 3% down, or again, partnered with somebody like HDF, it's 100, and they 105? Yeah. And they require 1% of your own money. The same thing with the other first-time homebuyer programs. They require 1% of your own money. Mortgage insurance and mortgage rates. I just want you to know what affects your mortgage insurance and your mortgage rates. It's risk. And risk means the higher your credit score, the better your rate. The higher your credit score, the lower your mortgage insurance. Okay? Mortgage insurance is what you pay when you put down less than 20%. Okay? So it is required by banking regulators that the borrower get and pay for mortgage insurance. The lower your score, the higher your rate. The lower your down payment, the higher your rates. Okay? So the risk is high because now you're borrowing 99% or 100%. So you don't have teeth in the game, and so therefore you're a high risk, the rates are higher. Okay? Any questions? Yes? No, but I think that's Roxana will explain that, okay? I see that in her slide. I don't want to touch it. No, it's not a first-time home buyer, but I'll leave that for Roxana to explain. Okay, so we offer fixed rates. Fixed rates are actually predictable monthly payments fixed for 30 years, 25 years, 20 years, 15 years, 10 years. And of course, if you want a smaller payment, you want to stretch it out to 30 years. It used to be there were 40-year mortgages, but now that's pretty much gone. Adjustable rates, that means to say it's fixed for 5 years, 7 years, 10 years, then after that, it goes up not very many people are looking at adjustable mortgages because the rates are still low. Even with the rates going up right now, they're still low. The products suited for these needs for first-time home buyer, which are the Fannie Mae first-time home buyer, you're required 3% down. HDF, which I have them here, will discuss their program. And we have the government first-time home buyer programs, the CHAFA and the FHA programs. And I can actually explain that to you a little later. But those are first-time home buyer programs. CHAFA can do some of the investment property if they are in what they call a target area. And we have to look at the area if the house that you're buying is in a target area, and they will allow investment loans. Investment property financing for landlords, second home financing, and new home construction are the programs that we have. So mortgage options, we have purchase, refi, minimal down, mortgage insurance, condo, and co-op. One thing that you have to know about First County Bank, we are a small community bank that really love our clients. We have the most number of condos approved, and we also are one of the lenders. There's not very many lenders that will lend to co-ops. Okay, so our bank, Chase Bank, who is our competitor, lends to co-ops, but I'll tell you, we'll beat Chase anytime. It's true, it's true. You won't get lost in our bank because we are actually small and everything is in one roof. Everybody is in one roof. So if I have a problem with my loan, and my husband hears this all the time, I'm talking to the president of the company. I'm talking to the CEO. I don't have to go through the red tapes and the bureaucracy of the bigger banks. I go straight to them, and I will actually write an explanation on why we have to help this client. And it's a fighting game, but I love it. It's tiring. I don't get okay to all of my requests, but I have a very good batting average. I do fight for my clients. So I'm going to turn the mic now to Stephen, who is going to discuss credit.
Excellent. Well, thank you very much, Beth. How about a big round of applause? All right, everybody. My name is Stephen Robert. I'm the owner of Bedrock Credit. For the past 15 years, I've been doing credit education and restoration, and it's my job to condense 15 years of knowledge in about 10 minutes. So, hang on to your seats. This is going to be a wild ride. All right, so we're going to dive right into it. The biggest thing that I see, and this is all about education today, guys. The biggest thing that I see is that people don't understand, rightfully so because of the ridiculous websites that are out there, there's a significant difference between what Beth uses on the mortgage side and what you're going to get with third-party websites. So there's a lot of third-party websites. I'm not going to name them all, but all these free websites that give you all your free scores. Anybody use those? Has anybody had the experience where you use that and then you walk into the bank, talk to Beth, and it's 40 or 50 points lower? And it gets very frustrating, doesn't it? All those third-party websites, please stop using. Okay? I mean, that's it. They're just not accurate. They're not going to give you a good understanding of what's happening with your credit. They either use their wacky scoring models anywhere, as you can see, from 100 to 1,000 points, or 990, or they'll only use 2 years worth of history. What Beth uses and what all lenders in the current United States use is known as something as the Fico scores. Okay? So FICO scores, FICO stands for Fair Isaac Corporation, have a monopoly on the credit world in terms of FICO scores, in terms of mortgages. Now, if you go get an auto loan or credit card, things like that, they might not use a FICO score, but today we're all about the home, so we want to know that. So the next thing to understand is, because I'm sure somebody here, right, oh yeah, I know my FICO score. It's on my bank statement. It's on my credit card statement, right? Is that the same score, the same FICO score that Beth uses? Who thinks yes? Who thinks no? Who has no idea? Right? So it's actually not the same. But Steve, you just said it's a FICO score. Yeah, it's a FICO score, but there's different versions of the FICO score. Okay, so here's the takeaway. In the year 2000, they built FICO Classic, which is known as versions 5, 4, and 2. In 2008, they built FICO version 8. 2014, they built FICO version 9. 2020, they built FICO version 10. They keep building up these new algorithms and passing it out to the public, but that is not what you're going to see when Beth pulls credit. Okay? So now the next question is, well, Steve, how do I get this miraculous FICO Classic score? Two options, right? If you think you're ready and you think you're prepared to go and try to apply for a home loan, you go and you sit with Beth. She takes all that wonderful information she was just talking to you about, and then she's going to pull your FICO Classic score, and you're going to get that information. On the other hand, what if you're not ready to go yet? What if you say, well, in the next 6 or 12 months, I want to be able to figure out if I'm going to be able to qualify? The only website to give you this information, myfico.com. myfico.com. myfico.com is the only website that will give you the same exact information that the bank sees. Now, again, when you first log in, you're going to see, oh, look, here's my FICO score, FICO version 8. You have to actually go down to the part where it says, these are the FICO Classic scores used in mortgage lending. Okay. Now, with FICO scores, or getting your FICO score, when you go to myfico.com, it does not count as an inquiry. Does not impact your credit in any way, shape, or form. However, you have to purchase it. Cost to do that is anywhere from $30 to $60, depending on which product you actually buy. The $30 one is good enough to give you your FICO scores at all 3 credit bureaus: Equifax, Experian, and TransUnion. Good? Okay. By the way, because I know somebody's going to bring it up, there is the website called Annualcreditreport.com. www.annualcreditreport.com is a great resource to give you your 7-year history, but no scores. So if you're just like, well, I don't need to see any scores. I just want to make sure I don't have any weird stuff on there, no strange inquiries, nobody's opened up accounts in my name. www.annualcreditreport.com. You can go there for free and get your 7-year history. Good? Beautiful. I only have 2 slides, so we're going to dive right into it. So, and again, a lot of information in a short amount of time. My contact information will be up there, and I'm happy to answer questions that are more specific, okay? So, there's 5 components. We'll just, right there, you can see all the information, right? Past delinquencies, revolving, average age of credit file, mix of credit, inquiries. I'm only going to give you a couple key points that I constantly see as trip-ups so that you can just kind of prevent anything from happening that could possibly cause a problem, okay? So very simply, 35% of your score is the biggest thing. What is that? It's your payment history. Basically, pay your bills on time. Goodbye. Right? Because it's really as simple as that. Pay your bills on time. If you do get behind, you have 30 days where it'll just be past due and it won't impact your credit up until, like, if it goes after that 30 days, boom, you're going to get hit with that 30-day late payment. And unfortunately, that can stay on there for up to 7 years. So try to make sure that doesn't happen, okay? You can then work with the creditor to try to remove it, blah, 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 all that good stuff. But point being is, pay the bills on time. Life happens, especially the past 2 years, okay? So I don't fault people that can't pay their bills. And if something does go 30 days late, 60 days late, 90 days late, and it gets into a charge-off or collection status, it's not great, but there's a specific way to handle it. And here's what I want to say about that. When an account is in an open charge-off or collection where you still owe that money, how you deal with that is going to be vital to making sure your credit is okay and that you're financially protected. Here's what I mean by that. Number 1, if you have a charge-off or collection, never put yourself in a payment plan. And that might be like, Steve, why not? I owe $1,000. They say they'll take $100 for the next 10 months. I can do that. Here's what's going to happen. You start paying your $100, month under 10 comes, hey, I made my last payment. Oh, yeah, you did, but it actually showed up in our processing center a day late. Therefore, you defaulted on the agreement. You still owe us the full $1,000. In the past 15 years, I've seen some crazy stories of people that have gone through these type of things. I don't want you to go through that. Now, you might say, but Steve, they want me to do a one-time settlement for $800. It's going to take me 8 months to do that. You know what? Wait the 8 months, gather the funds, and then go back to them and do the one-time settlement. Okay? Now, when you're ready to do that one-time settlement, and again, these are things I can help with if you have specific questions, but when you're ready to do that, number 1, you need to get a settlement letter in writing. You have to get some documentation that says, if I pay you X amount of dollars by this date, that you're going to go ahead and take care of this debt. When you pay it, never, ever, 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 ever give out debit card, credit card, or checking account information. You have to protect yourself financially. Okay? You want a real life story? It happened about 5 years ago. Lady had this $1,000 collection with Verizon. ABC collection company called. Finally, she's like, okay, leave me alone. I'll pay you. Here's my debit card. I want to settle $600. Okay? 3 months later, XYZ collection company calls and says, hey, we're calling you about this Verizon debt. What did she say? Oh, so it was your account. So you verified that it's yours. Goodbye. Click. She's like, well, that's weird. Next day, she checks her account. That company, XYZ collection company, used the debit card that she gave to ABC collection company, pulled out the $1,000. Is that legal? Who's my attorney? Is that legal? Yeah, it's not. But this is what these collection companies do. And to protect yourself from ever being in that situation, don't give out your personal financial information. And you're going to get pushback. Oh, no, well, we can't give you a settlement unless you pay us. Well, you're not getting paid. So give me my settlement letter in writing, and then once I have it, I can pay you with a money order or certified bank check so that they don't have your financial information. Good? Okay. Then you have to work with the credit bureaus, all that good stuff. I won't go into all the details now, but I just want to give you that information. The other one that's really, really important that I see all the time, medical debt. Medical debt is a different animal than just like, say it was a Verizon collection or a Capital One collection. That's kind of over in this category. Medical debt is different, okay? First of all, dealing with medical debt, always try to deal with the doctor or the hospital directly. Don't deal with the collection. Even if it gets kicked out to the collection company, oh, yeah, this is Joe's collection company. We're collecting for Bridgeport Hospital. Okay, goodbye, click. Hi, Bridgeport Hospital, did I owe you guys a bill? I thought insurance covered it, whatever. Oh, I do owe you a bill? Fine, I'll pay you guys directly. I'm not willing to pay a collection company. Okay? Now, when you're dealing with the hospital directly, you can use your debit card or credit card because you're dealing with the regular company. It's the collection companies you got to stay away from, okay? Again, with the medical company, you might say, well, I have a $1,000 bill, and it's at Bridgeport Hospital, whatever it is, insurance can cover it, whatever, and they're offering me a payment plan. Can I do that? Yes. In that situation, you can because, again, you're dealing with the original creditor. And it's even better to even get it to the collection company, so prevent that from happening by reaching out and being proactive. Hey, I was just in there last month. I had some type of procedure. Insurance should have covered it, didn't, blah, blah, blah. What do I need to do to put myself into an auto debit payment plan with you to make sure that you're getting the money you need so you don't bother to kick it to a collection company and mess up my credit? Make sense? Okay. All right. That's all I'm going to talk about for the past delinquencies because I could go on and on and on. 30% of our score is debt utilization, okay? Debt utilization is different than what Beth cares about. Beth cares about what? Who's paying attention? DTI, right? Debt to income ratio is what we care about on the finance side of things. Debt utilization is what we care about on the credit side of things. Very simply, how much money do I owe compared to my limit? If you have a $1,000 credit limit and you owe $1,000, what's your utilization percentage? Oh, you didn't even need calculators. Good for you. Okay? Having that high utilization is going to hurt your scores. Here's the tricky part. I have this conversation on a daily basis. Well, Steve, it's okay because I max out my credit card every month, but the day I get my bill, I pay it in full. Who thinks that's okay? Who thinks it's not okay? Who has no idea? It's not okay because the credit card companies only update the credit bureaus one time per month. The day that bill goes out to you, whatever that balance is, that's what's going to show up at the credit bureaus for the next 30 days. So you got to make sure that you're paying your bills. First of all, don't use that much. Literally, I tell people, I don't care if you have a $300 credit limit or a $30,000 credit limit. The most you should put on your credit cards every month is like 20 or 30 bucks. Okay, I used to say 1 tank of gas, but can't say that anymore. That's like $200 right there. So, but point being is you only want to use it a little bit every month, wait for the bill to come in the mail, pay it off. And if you do have that high utilization for whatever, holiday shopping or whatever, you have to put a tire in the car, I get it. But as soon as you can, work on paying that down. And once you do pay it down, do not close your cards. You need to have cards open and active. And I hear this conversation all the time. I don't like cards. I don't like credit. I just want to pay cash. Well, that's great until you go to Beth and you have no score. So you need to maintain and build credit. So you have to do that by just doing it and doing it properly, whether it's a car loan, whether it's student loans, or whether it's revolving credit cards. Good? All right. Average age of the credit file basically means if you're constantly opening up new accounts, it's going to hurt your credit. So don't do that. Yes, you need to have credit cards. And yes, 10% of our score is a perfect mix of credit, which says you need to have 3 to 5 credit cards. So if you only have 1, guess what? You should open up 2 more, whether it's a regular credit card or a secured credit card. And yes, you're going to take a hit for an inquiry. And yes, you're going to lower the average age of your credit file. But after 6 to 12 months of on-time payments, it will really start helping you. You'll be building the positive credit history you need, and then you'll be able to get approved. Okay? And the last 10% is inquiries. And here's a really cool thing about inquiries. With mortgages and auto loans only, you have a 30-day window to go shopping as much as you want to try to find the best interest rate. Not that you need to, because Beth is amazing. But I'm just saying that, say you went to Joe's mortgage shop last week, and now you're like, I don't know about Joe. And now Beth is like, well, I can pull your credit. Well, no, don't pull it. I don't want to hurt my inquiry. It's okay. You're within 30 days. You could have 20 people pull it. All 20 will be listed, but it only impacts your score 1 time. Okay? And that works only for mortgages and auto loans. Cool? All right. The last thing I'm going to say, and this is just my information, if anybody has any questions, certainly reach out to me. But the last thing I'm going to say is that credit in itself takes time, a significant amount of time to deal with, okay? Especially with the delays that we've seen since COVID. I mean, the credit bureaus have basically just wound themselves down so much. Yes, the CFPB kind of gave them a free pass for the first year, but now they even came out and was like, hey, credit bureaus, get your act together. They didn't get their act together. So things take a significant amount of time to try to fix any type of credit issues. So if you think you have any issues or you're planning in the next 6 to 12 months to want to work with Beth and talk about a home loan, make sure you look at it today. Because if there are issues, it's going to take some time. Best case scenario, you run it, it's a 780. Perfect. You have nothing to worry about. Keep doing what you're doing. But worst case scenario, you thought you had a 700. You pull credit through myfico.com. Mortgage score shows you actually have a 600, and you're thinking to yourself, man, I really need to get this into better shape over the next 6 to 12 months. So when I do want to work with Beth, I'm where I need to be. Sound good? Excellent. Thank you so much for having me. This is fantastic, Pastor. Appreciate it.
Okay, thank you, Stephen. That was really great. I need a clicker. Okay, we got HDF now. Roxana, thank you. And Katie's going to do this for me. Yes. Okay. Hello, everybody. How is everybody doing this afternoon? Thank you so much for having us here, and thank you, Beth, for inviting us. I'm the director of the Home Buying Development at HDF, or Housing Development Fund. Now, I'm here with Kate Gravelin. She's our underwriter in our lending department. So we have 2 sides. We have the counseling side and we have the lending side. But I want to start by answering your questions, sir. So you ask if you own a home, if you can benefit from our programs. And unfortunately, when you own a home, you are not longer considered a first-time home buyer, unless you sold the property 3 years ago. So if you sold the property 3 years ago and you didn't own any home and you want to buy, then you will consider to be a first-time home buyer. The only exception will be that if you lost that home that you had due to a foreclosure, then it has to be 7 years. But if it was a short sale, it has to be 4 years since that happened.
All right. So I'm going to let you know who we are. Who is Housing Development Fund? Housing Development Fund is a non-for-profit organization, and we were founded actually in 1990. That's when it began, in 1990. And we have two offices. We have one office in Stanford, but we also have one in Bridgeport. We're located on 1111 Main Street, on the ground level, right next to, like passing the court, is right there, 1111 Main Street. Now, to qualify for HDF down payment, we offer down payment and closing cost assistance to first-time home buyers. In order to qualify, like I mentioned before, you have to be a first-time home buyer. You also have to be income eligible. There are certain income limits for our down payment and closing cost. So if you're buying, let's say in Fairfield County, anywhere in Fairfield County, for our down payment program called Smart Move, your income cannot exceed $121,100. So it's high, $121,100. It cannot exceed that. And we have to count household income. You also have to be a U.S. citizen, U.S. resident, or have an approved visa without work visa. If you have the DACA program, that qualifies as well. Also, we offer, besides the counseling, we also offer classes. So if you think that, if you're not so sure, if you are ready, oftentimes I get phone calls where clients, they ask me, I don't know if I'm ready to buy a home right now. So I tell them, you know what about if you take the class? The classes are free. We offer classes, and the classes right now we're offering via Zoom, and these are 6-hour classes. You can also go to the CHFA website, chfa.org, and right there you can see the list of agencies that offer the class. And these classes are for free, and you can learn the process of buying a home, and that will give you an idea whether or not you're ready. Because these classes, they talk from the beginning of what types of properties there are, the mortgage process, and up to the closing from beginning to end. So that way it will give you an idea. But at HDF, we also offer the counseling. So if you come to us, we're going to ask you for documents. We're going to ask you for tax returns, for your pay stubs. We're going to pull your credit report, and we're going to do an assessment, and we'll tell you whether or not you're ready. If you're not ready, we'll give you an action plan, and we'll tell you what are the steps that you need to do, what are the items that are preventing you from taking the next step of getting pre-qualified. Maybe there are credit issues. Maybe you don't have the savings for the expenses that you need to pay. For instance, with our programs, even though we have down payment and closing costs, you are required to put 1%. And 1%, you also have to, as Beth mentioned, that you have to pay for the appraisal. You have to also, we require that you do an inspection on the home. You have to pay for the inspection. So maybe the savings are not where they need to be, but we'll guide you. And that's why we give you an action plan, and we'll tell you what is it that you need to do. And if you're ready, we'll send you to our participating banks. First County is one of them. So in order for you to submit the paperwork that we need to do the assessment, we have different choices. You can go to our website. Our website is hdfconnects.org. And you can upload there your documents. You can create an account, and then you can upload your documents, your tax returns, your pay stubs, your ID. We do ask that you pay for the credit report. The counseling is free, but you do need to pay for the credit report because that's a third-party fee. And we'll charge you exactly what we get, what it costs, the credit report. And we pull from the 3 credit bureaus. So right there, if you can see, I don't know if you can see right there on the screen, but that's our website, hdfconnects.org. You go where it says, there is a tab above that it says services. You click there, and then you go down where it says first-time home buyers. And you click there, and then you will see like a green button there that it says start your journey here. You click there, a lot of clicks, but once you click there, then you will be able to create your profile, and you can upload your documents. But if that's not the way that maybe you don't have a computer, maybe you are not computer savvy, you prefer to hand the paperwork in person, you can do that as well. Like I said before, we have a Bridgeport office. You can go to the office. The business hours right now are Monday through Thursdays from 9 to 4. You can go there and you can submit your paperwork. You can request an application there. Also, we have a fax. You can submit the paperwork via fax or via email, whichever is more convenient. Or you can mail it, whichever is more convenient for you. Once we receive the paperwork, it usually takes us 10 business days to assess your file and let you know whether or not you are eligible for the down payment, whether or not you are eligible for the closing cost. And if you are not ready, we'll give you an action plan and we'll tell you what you need to do. Now, we also, we ask for, like I said, for different paperwork. But once we have the paperwork, we do the assessment, we tell you about the classes, and then once you are ready, we'll send you to the bank to get pre-qualified. And once you are pre-qualified, then you find a home, you start looking with a realtor, you find homes, and once you are ready and you found a home, and we told you that you were eligible for our programs, then you can apply. Once you apply, we submit, the counselors will submit the file to our lending department, and Kate will review your file, and she does the underwriting, and then she will let you know whether or not you've been approved. She presented to a loan committee. We have a loan committee, and then they make the decisions. Does anyone has a question that I can maybe answer? Yes. Mm-hmm. No, and that's a great question. If you didn't hear, she asked if you have to live in Connecticut. No, actually you can. I had a client who was moving from California. No, you don't have to live in Connecticut right now, but you do have to buy in one of our service areas. Our service area is all of New York, all of the state of New York, and all of the state of Connecticut. And you have to be within the income limits. So that's the requirement. And we have down payment and closing cost, but we also have two loans right now, the Smart Move, which is a loan where you make monthly payments at 3% fixed, but Katie's gonna talk about that. I don't want to describe the programs, but she will explain to you the programs that we offer. But yes, you don't have to live in Connecticut to benefit from our programs. Any other questions that you may have? No? Yes. Oh, for the classes, yes. Well, we do via Zoom. You go to our website. That's okay. It's hdfconnects.org. So you go to our website. You're going to click where it says education. There is a tab there that it says education. You click there, and then you will see the classes. If you don't see a class coming up, because we offer it quarterly in English and Spanish, and if you don't see it there, you can always go to the CHAFA website, chfA.org. And right there, you will see the list of agencies that offer the class in Connecticut. And you can choose with them. If you see, we will be listed there too, under the CHAFA website, and you will be able to see the classes. And the classes, those classes are free. And right now, some agencies do it via Zoom, some do it in person. We're doing it via Zoom right now until we know that everybody will be safe, and but that's what we offer, and I hope I can get to see some of you, or I get to be your counselor. And I speak Spanish, so if any one of you speaks Spanish, I offer the counseling in Spanish as well. So now I'm going to hand it to Kate. Thank you.
Hi, can you hear me? I'm actually going to sit, if you don't mind. 2 reasons. I just had a milestone birthday, and apparently my eyes are not what they used to be. So I'm going to look off my slides here, and also I wore heels, so my feet are killing me. My name is Kate Graveline. I've been with the Housing Development Fund for, this year will be my 9th, almost 10th year with the Housing Development Fund. I have worked in all positions with them. I started as a counseling assistant, and I was our mortgage loan processor for a little while, and now I am our underwriter. As Roxana said, we are a nonprofit. We're located in both Bridgeport. I actually work in the Bridgeport office myself. Roxana is in Stamford. I am a huge fan of HDF. I've used HDF myself. My son's father has used HDF. It is a extreme advantage in a community. It is extreme advantage as a first-time home buyer. It's a wonderful program, and I don't have enough things to say about it, but okay. So in order to take advantage of any of the products with HDF, you must do the following three things. You must become mortgage ready. As Roxana explained, you will sit with a counselor, and they will determine what you're eligible for and whether or not you're mortgage ready. Look at your credit, look at your income, whether or not you've been a first-time home buyer before. You must be income eligible and remain income eligible up until the day that you close. If you start off with us, you have an application in with us, you lose your job somewhere along the way, you'll have to be reassessed. Some people we have come in, they go and get a new job halfway through. It just means that your income will have to be looked at again. And you have to attend an 8-hour course, which Roxana explained can be done either in Zoom or in person, depending on the agency. And that's where you go to CHAFA and look for those classes or our website. As Roxana explained, there are income limits as a household. If you do live in Fairfield County, the income limit for the household is $121,100. We consider a household member anyone over the age of 18 who is employed. So if you are working, if there's two in your family and you earn $60,000 and your husband earns $60,000, that's $120,000 as a household. In order to take advantage of any of the HDF loan products, you must have sufficient amount of savings in order to, one, put our 1% down requirement. What this means, if you're buying a home that's $100,000, we require you to put $1,000 of your own money into that home. It cannot come from a gift. It has to be yours. Basically what HDF does is we help you to acquire 100% financing. As Beth was explaining, lenders do look for a traditional 20% down on a home. HDF Smart Move program is going to help you to get that 20%. I'm going to use a $100,000 example again. If you're buying a $100,000 home, $80,000 of that is going to come from Beth, $20,000 of that is going to come from us at a 3% fixed interest rate. What that does is that eliminates that private mortgage insurance that Beth was talking about, which can become very costly, especially for somebody who does not have a high credit score. When you're paying HDF Smart Move loan at a 3% interest rate, you are paying down your principal. PMI is insurance that you're paying for the bank. It doesn't go towards the principal of the home or the interest rate. You are paying for the bank to be insured that you are going to make your payments. It only helps them if you don't. So what HDF's down payment assistance program, it's called a Smart Move program, does is it helps you to give that 20%, we're going to loan you that 20% on the home at a 3% fixed interest rate, and therefore eliminating that private mortgage insurance that will be going towards nothing. Right? Okay. So in order to take advantage of our products, you have to put a minimum of that 1% down. You have to have 2 months of mortgage payments in reserve. If your monthly mortgage payment in total is $1,000, we are going to require you to have $2,000 in the bank. We need to see it. It will have to be verified. It has to be there when you closed. If you are buying a multifamily home, we require 4 months. So if it's a $1,000 mortgage, we need to see $4,000 in the bank. We are not going to require you to take that money to the closing table. It's basically insurance for us. We know that you now have 4 months of payments in the bank to make the first 4 months if anything else arises in your household, anything like that. We are not going to require you to pay that up front. We just have to see that it's there. And any other cost, you must have any other cost that's required of purchasing that home. Inspection, appraisal, taxes, insurance, all of that needs to be there as well, and we will take that into consideration. HDF lending requirements. HDF guidelines for our front and back end ratios. You heard Beth talk about your DTI. The front end is your income, period. That's it. We would like it to be at a 3341. You'll hear numbers thrown around. It's important that when you go to a lender or when you're buying a home, you understand some of these terms. The education that's provided in the 8-hour classes that are required has tons of this information. It's only to your benefit. When you go to buy a home, you need to know, you can't just sit there as a lender or anyone else is throwing numbers around. You need to go there educated, and you need to know what they're talking about. When we talk about ratios, the back end, I am looking at everything, what your house is gonna cost you, along with what you pay on a monthly basis based on your credit report. Anything that comes in as monthly debt is taken into consideration in that back end ratio, okay? And the front end ratio is just your housing payment. HDF asks, and our guidelines state that borrowers should be at a 3341. It's a conservative ratio. What happens in most cases with our borrowers is our loans are submitted to a loan committee, which are members of all of our participating banks. They vote on our loans. They look at all types of things, not just the ratios. We also look at compensating factors, such as credit, housing shock, and the amount of savings you have. So that 3341 is a starting point. To take advantage of any HDF products, you must be using an HDF participating lender. You have to attend that homebuyer education course, and that's it. HDF lending products that we currently have are the Smart Move Connecticut and the Live Where You Work. Here's the difference. Smart Move is that 20% down payment. Live Where You Work, it is a program that can cover both down payment and closing cost assistance. HDF Smart Move down payment assistance. It is now up to, I say 20, but it's also 25% of the purchase price because your Smart Move can now cover some of your closing costs as well. It sits in a second lien position as a second mortgage on the home that you're purchasing, and it's a 20-year term at a 3% interest rate. There is a monthly payment, but like I said, the payment that you're making to HDF on that 20% is paying down the principal on your home. And there is a $750 to $2,500 service fee added to the closing costs. Any loan that you're going to get, you're going to have a closing cost. You're going to have closing costs on. The second product that we offer is the Live Where You Work. It's a down payment and closing cost assistance. It's up to $20,000 at a 0% interest rate. There's no monthly payments on this, and it's payable upon sale or transfer of title, refinance, or payoff of the first mortgage. You must live and work in the same town that you're buying in. If you live in Bridgeport and you're buying in Bridgeport, perfect. A lot of us are working from home now, permanently. It's acceptable. If your employer allows, if you work for a company that's out of Stratford, but you live in Bridgeport and you work from home, we do accept a letter from your employer stating that you are working from home. So you would qualify for that loan product as well. And there's a $750 closing fee on that. Eligibility requirements on the Smart Move. You must be a first-time home buyer, purchasing in Connecticut or New York. Household income cannot exceed those income limits that were listed earlier. You have to complete the counseling process with Roxana prior to sending your loan to me. You have to obtain a first mortgage through an approved lender. And the property must be owner occupied. You have to be a U.S. citizen or permanent non-resident under a certain visa classification. Bankruptcies must have been discharged at least 4 years ago. Foreclosures within 7 years of the application, and no short sales within 4 years of the application. My underwriting guidelines: when your loan gets to me, the borrower must have contributed that 1%. Because we're doing 100% financing on most, what happens is you're buying that $100,000 home, 80% is coming from Beth, or $80,000 is coming from Beth, $20,000 is coming from me, and then your question is what happens to my $1,000 that I put in as my down payment. We will roll that over, and it'll cover some of your closing costs. 3 lines of credit with 12 months of on-time payments, really important. Stephen talked about it. Having those open lines of credits, don't close your card. I'm looking for active trade lines that have been paid in full for 12 months or more, that currently have a balance. So when I look at your credit report, if you have a Visa card and a Capital One, but you don't have another line of credit, we also accept something that we call a non-traditional. This can be a Netflix, gym, insurance, utilities. I just want to see that you have paid those bills for 12 months on time, in full, and you're good to go. And at least 2 years of continuous employment is required. If you were a student, then we accept any type of transcript from the school that you were in previously. Any questions? Ooh.
Thank you, Kate.
Oh.
Go ahead.
It's wherever the base office that you are. So, for example, I live in Prospect, but I work in Bridgeport, and we have an office in Stamford. My base is in Bridgeport, so I would be considered in Bridgeport. Wherever your employer tells you where you're hired to work out of is what we consider that town.
Thank you. If you work in more than one location as a 1099, what would you consider to be the base office? Or do we decide that?
I can answer that question because I look at the eligibility. So if you get a 1099 and you report that as a self-employed, and if you do some of your job at home, it could be doing the billing for the company, then yes, we'll use that to say you also work from home. But now, if, for instance, I had a client who is a landscaper, and he uses just perhaps one day at home to do his billing for his company, but he's outside working at different homes, he wouldn't qualify because most of the time he's outside. Now, let's say I had another client who is an interior designer, and she spends all the time at home doing the designs. She will qualify because most of the time she's doing the work from home, even though she's self-employed. But yeah, it depends what is it, if you are working outside as self-employed or if you're working in your house. Mm-hmm. Yeah.
The principal amount on your home, if you're buying a $100,000 home, that $100,000 is the principal. When we say principal, your entire monthly mortgage payment consists of your principal, your interest, your taxes, and your insurance. Okay, so your principal is what you purchased that home for. Bottom line. Oh, what you're borrowing?
The amount that you're borrowing.
The amount that you're borrowing. Yep. Anyone?
Can you kind of break down a little bit what is included in that closing cost? Because I know sometimes, like, there's certain things that you guys said that would be included in a closing cost, and then some that aren't.
I'll take that. Okay, so closing costs, usually you will have your lender's fee. That's what the bank will charge you. Underwriting fee, admin fee, processing fee, doc prep fee. And they range from anywhere from it used to be $500, but after 2021, they raised it, all the banks, because Fannie Mae actually was raising refinances across the board. So what the banks did is they just increased instead of increasing the rates, they increased their lender fees. So for example, our bank has a lender fee of $897. Then there's a government fee. Don't ask me, but the government wants you to actually have a FEMA flood cert fee, which is $24. Okay, you have no escape. You can't say, but my house is not in a flood zone. They will still ask you to do that. Then there's what they call a tax service fee. That's anywhere from $82 to $160, depending on the size of your loan, okay, or the cost, the price of the appraised value of your home. Then you have your attorney fees, and he'll talk about that, but they run about, if you have a $200,000 loan, you have title insurance, his legal fee. If it's a refinance, it's cheaper than a purchase, you know, and then there's a title search fee and a recording fee, and some attorneys charge a miscellaneous courier fee. Did I miss anything else there? Andy? Okay, that's it. So let's say you're buying a $200,000 house. $897 is your lender fee. 100 is your tax or government fee, so that's $997. And let's say my bank gives you $1,000, so that's wash. Then you have the appraisal fee. The appraisal fee, like I said, is $480. And then you have the credit report fee. So let's say there's one person in the loan, so that's $28. Like HDF, we charge you what the third party will charge you. We don't have any profit. We just pass on the bill to you, and you pay it. Okay. And so if your attorney's charging you, we call him a figment of our imagination, a cheap attorney, right? So anyway, let's say it's $2,000 for that price loan. Okay. And you have $480 and another $28. So you're looking at about $2,500 of closing fees. Now, there are other fees that you're going to pay. It's called funds you need at closing. It's going to be your interest in advance. So if you're closing the 15th of, let's say, March, we're going to charge you from the 16th till the end of the month because you're not getting a bill next month. You're getting a bill the following month. Then you have to pay your taxes. Depending on what town you're actually in, you either pay every quarter or every 6 months. So let's say you're in Bridgeport, so you're going to pay 6 months. And you're going to close, let's say, this month. So I have to collect 3 months of taxes and 2 months escrow because I'm going to actually have to make sure, or your attorney has to make sure, that I think he's going to go over that your taxes are paid. Your taxes are always paid in advance. Unlike your mortgage payments are always paid in arrears, your taxes are always paid in advance. Another thing that you need to pay in advance is your homeowner's insurance. You have to pay for this a full year. And homeowner's insurance, believe it or not, is also credit score sensitive. They are going to ask your credit score. Your rate will depend on your credit score and the location of the house and whether you have a fire hydrant, if there's a store next to you and all that stuff. So I've seen homeowner's insurance anywhere from $127 to $200 for a $200,000 home.
Per month.
So those are advanced monies that you have to bring at close. They're not closing costs. They're actually things that you have to pay because you now own the house. Did I explain that? Okay. I actually have a question with HDF. I don't think I heard it or you didn't touch it. I believe that you also can do multifamily, right? Yes. So you want to expound on that?
Yes, we do single families, condos. So our programs, you can use it to buy a condo, to buy a single family house, or a multifamily. Multifamily is considered 2 to 4 units, no more than that. We have a commercial side. If you want to buy a bigger project, more than 4 units, then that will be under commercial side. But on the residential side, the only thing that we don't lend for is unfortunately co-ops. Co-ops or land, we don't.
And that's where First County comes in. We do co-ops, but for co-ops, the co-op itself will require 20% down. The nice thing about co-op is you don't pay taxes. So you remove that 6 months or 7 months or 4 months of taxes that you need to pay. And because it's a co-op, I just want you to be sure, to know that not only will the bank have to approve you, but the co-op board has to approve you. It is a big thing. A lot of people are buying co-ops because they're affordable, but not very many banks actually lend to co-ops. And lenders right now are not lending to land, okay? So if we're all done,
We've
You
got
have
a
a
couple
question?
more
Go
questions
ahead.
here. For the next question and answer, we're just going to ask that you come up to this microphone so we can know, so we can hear and see you. And we'll keep it going.
Go ahead.
Hi, thank you all for being here. I have two questions. The first one's a two-parter, and the other one is distinct. The first question is for HDF. Is the home assistant program, is the down payment assistant program entirely a loan, or is it like a part loan, part grant? And if so, since it's a second mortgage, are applicants, are participants paying that mortgage simultaneously with their first mortgage, or is there like a deferred period, like maybe they pay after the first mortgage is paid? And the second separate question is for anyone. Can somebody explain the difference between an appraisal and a home inspection?
Sure, I can answer those questions. So the first one is about if the down payment is a mortgage or is a grant. The Smart Move, we have two right now. We have the Smart Move, which it could be used for down payment and closing costs, and it's a second mortgage. So the payments will be separate than what from the bank. So you will be paying to the first mortgage, and then you will be paying the second mortgage to HDF. It's happening simultaneously. So once you start making the payments, you will be making the payment to the bank, in this case, if you use First County Bank, and HDF will be separately. But ours is for 20 years. So at the end of 20 years, you had paid us off. Now, the Live Where You Work doesn't have monthly payments nor interest. It's a 0% interest. But you do have to pay it back. And when do you pay it back? When you sell the property, refinance, transfer title, or when you finish off paying the first mortgage. That's when you pay it back. So right now we have those two, but you do have to pay it back.
For your second question, he's coming next. He's coming to speak. So let him answer that when he does his presentation. So we have question and answer also after. So
Yeah, that was somebody else. He had two questions. I'm a different person.
Oh. Okay.
Yeah. So my question.
So you're going to be the last one because we have 4 more speakers, right?
Okay. My question was, what's the max on approval someone can get for an HDFI loan?
Oh,
I think you're talking about the income limit.
No, I understand the income limit is
Oh, okay.
121.
what is the
Yes.
maximum
What is
loan
the
amount?
maximum?
Yes.
Okay. The maximum is based on what you can afford. As long as your ratios do not exceed 33:41, that's what you can afford. And what you can afford is based on your income and your debt. And the ratios have to be within that bracket. So we will have to see income and your debt to see how much you can afford.
Now, that's where we come in. Our ability to pay is based on your debt-to-income ratio. In our bank, we don't look at the front-end ratio, which is your housing ratio. Housing ratio is your mortgage, your taxes, your insurance over your income. We actually, for our bank, we can exceed 41%. So we look at your overall debt-to-income ratio, which is the back end, your total debt. So if you're asking me what is the maximum that you will be approved for, I have to look at your total debt, and your income. So the rule of thumb, I always tell my clients, so let's make it easy. You make $10,000 a year. Of course, I know you make more. If you multiply that by 4.8, that is the maximum, most likely loan that you're going to be able to get from First County Bank for a regular purchase, whether it's 3%, 25%, 10% down, not for HDF, because their debt-to-income ratio is 41 back end. That's the total debt. So that means to say if you're making $10,000, you really have to look as your total debt to be multiplied by 4.1, okay? And your front end, meaning to say your taxes, your homeowner's insurance, the principal and interest, has to be times 3.1 of your total income. Did I explain that?
Yes.
Okay. So that's an easy math, but it's not like science. It's not like accurate. It's just an estimate of what you can afford, okay? So let's go now. Let's go now to the attorney over there. 5 minutes. No.
I'll just throw all this stuff out. I'm going to stay seated too. Probably have guessed already, my wife is the speaker in the house. So what I'm going to do is try and walk you through the high points of getting from the offer to the closing. And I think I'm going to throw a lot of this out or abbreviate it. So you're obviously looking for a house. You've probably been online and looked at Zillow and all of those sites. You may have talked to a real estate agent or a real estate broker, and you're now ready to go look at homes with a broker, and you drive around town and you see all kinds of places, like we did. Beth and I looked for months, and then you find something that you like. What do you do then? Well, you work with your real estate agent, and you're going to make an offer, okay? What should be included in the initial offer? You know, obviously the price. That's probably the most important thing. But you need to keep in mind that when you make your offer, and I'm talking about the way it's usually done. There are exceptions to everything. But usually when you make your initial offer, you write a check or you put down 1% with that offer. You give your real estate agent a check for that as good faith. Now, when you make the offer, you're going to have some kind of, you're going to want to include in the offer a number of things. Obviously, we're here talking to lenders. You're going to put in a mortgage contingency. That means part of your offer says, my offer and my ability to close is contingent upon getting a mortgage from a lender for X dollars, okay? Whether it's the 80%, whether it's more, if it's an HDF program, it could be, you know, the full amount of what's available under that program. But in your offer, you're going to specify that you need a mortgage, and you're going to put in that offer the amount of the mortgage that you need, the kind of mortgage it is, conventional mortgage, which would be a straight mortgage from a lender, or a government program mortgage, HDF, CHAFA, something of that sort, how much of a mortgage you need, and how much time you're going to have to get a commitment for that mortgage. You're going to put in the offer the need for inspections, and Bob Kamara is going to talk to you about inspections too. Inspections are, when we talk about inspections, maybe I can answer the gentleman's question a little bit. Inspections mean someone, Bob or someone, going out physically to the property and looking at the heating, looking at the roof, looking at the walls, looking at the physical nature of the property, seeing if there are problems that need to be remedied. Okay, that's the inspection. And you're going to have or want a contingency for that report to come in. You're going to often, this is done less often, but you may want an appraisal contingency. And the appraisal is a licensed appraiser who does work. He'll look at the house too, but he will also look at the history of sales in your area and make a determination of what he thinks the property is worth. Okay, so that's the appraisal. That's different than the inspection, which is basically the physical condition of the property. And you may want to ask in your initial offer for an appraisal contingency, that the property appraise for at least what you're paying for it, okay? The appraisal is usually, as Beth said to you, the appraisal is done by the lender, but you probably want in the offer a contingency for it being sufficient. You're going to put in the offer when you expect to close. Okay, it's typical 30 to 60 days, but it's all negotiable. If the seller needs time to get out of the property, they may ask for a longer time. If you need to get in sooner, subject to getting your mortgage, it may be negotiable to make it sooner. You're going to put into your offer what's known as inclusions and exclusions. The multiple listing will say that certain things go with the property. Usually it's the appliances in the kitchen, washer, dryer, refrigerator, things of that sort. Sometimes certain items are specifically excluded from the deal. People like to take chandeliers that have, things like that, specific items. If they do, then you want to put in there that they're going to replace them with something reasonable. Realtors generally use an exclusion-inclusion form that lists these items, and that gets to be part of the deal. If the property is multifamily, you want to put in your offer that it's legal. You want to make sure that if it's a two-family, it's a legal two-family. If it is an in-law apartment, you want to make sure that that is legal as well. And it's good to put all these things in the first offer because they're going to end up in a contract at some point, okay? And the more you can get these items addressed up front, the easier your job is going to be. You're also going to get, and I'm not sure if somebody else is going to talk about this, you're going to get, when you view the house, 2 disclosure forms. One is a state real property disclosure form. It goes on for 5 or 6 pages. It discusses the water system. It discusses the septic system. It discusses asbestos. It talks about whether you're in special taxing districts. It goes on for, it's an attempt for the seller to tell you, or any buyer, a lot about the house, and that's important. You will also receive a federal lead paint disclosure. Before, I'm trying to remember, I think it was 76, but I might be wrong. It was common to use lead-based paint in residences. As we all know, those are created all kinds of horrible situations, especially for children. There is a disclosure form that the federal government requires that doesn't tell you about the property, but tells you that you have an opportunity to investigate that. So you make your offer. You put these things in the offer form, and the seller says, okay, let's move forward. Or they negotiate. They come back to you and say, you offered $200,000, we want $210,000. There's a negotiation, and you do that with your real estate broker, okay? At some point, there is a meeting of the minds. The buyers and the sellers agree on these items, and the question of how you get from that meeting of the minds to a binding contract would take me about 2 hours to explain. The problem is, excuse me, that in today's world we have as many ways of doing that as there are real estate transactions. It used to be that you would submit an offer, the seller would accept the offer document would go to the seller's attorney, and the seller's attorney would prepare a contract and submit it to the buyer's attorney. There'd be some negotiation back and forth, and ultimately the buyer and the seller would sign the contract. Now, typically with the signing of the contract, there is a deposit of 10% of the purchase price. I hate that system, but that's the way it's generally done in this area. That's negotiable, but for those of you who are first-time buyers, you're going to be faced with that question. If and when you ask for a lesser deposit with the contract, that will almost certainly get pushback. So just be prepared for that. As I said, there are a lot of ways that this is done. It depends on what town you're in. It depends on what your broker is comfortable with doing. It depends on a lot of concepts that really would take more time than I have. What I'm suggesting to you is that let me back up a little bit. Recently, meaning the last few years, it has become more common for brokers to prepare the contract. And there are some forms out there that are multiple listing approved forms that are full contracts. They do not anticipate the attorneys drawing them up and negotiating them. So if these full contracts are signed, that's a binding deal, okay? It may have contingencies in it, but it's a binding deal. So you need to be very careful when you do that. The buyer's attorney's job is to protect the buyer in this kind of situation. So if they do not have the opportunity to review what you sign before you sign it, and it's a binding contract, there can be issues that come up that are not best suited to protect the buyer. I always suggest to clients that if they're going to sign a contract, that it have an attorney review provision in it. Many of the form contracts do have that, and what that says is, for a period of time after this is signed, each party has the right to take it to their lawyer and to get advice as to what they've signed and to negotiate additional terms or even, if necessary, to walk away from the deal. It's usually only very limited in scope or in time to maybe 5 days. But if you're going to sign a contract, a broker form contract, please make sure that it has an attorney review provision in it, okay? Because the forms attempt to be fair, but there are things that any buyer's lawyer is going to insist on, and they're going to do that under the broker review provision. So I'm going to skip a couple of pages where I tried to explain much more about that. So we're now at a signed contract. You have a binding contract, and the buyer and the seller are bound by it. You have your inspection contingency in the contract, and Bob goes out and he reviews the property. If there's things that he sees that make you feel that you need to renegotiate the contract, that's the time to do it. These things are sometimes resolved by the seller agreeing to fix something. Sometimes they're resolved by a credit. That's all negotiable. That's all stuff that has to be addressed. Now, if it's a broker form contract, the inspection period takes place after the contract is signed by both the buyer and the seller. If it's an attorney contract, the general way it's done is that the seller's attorney drafts the contract, sends it to the buyer's attorney, but it is not signed by the buyer until the inspections are done and the issues, if any, are resolved, and then they're put into the contract. During the time that the contract, or after the time that the contract is signed, there are some things that your attorney is going to do for you. He's going to have the title searched. That's a review of the land records in the town that the property is in to make sure that the seller owns the property, that it's free and clear, to determine what the mortgages are because they're going to get paid off at the closing, to see if there are any liens or other problems that would impact the ability to sell or that could diminish the value of the property. And those are resolved between the attorneys if they're resolvable. Your attorney's also going to order what's called a municipal search. That's not the land records. That's a search of the building department in the town to make sure that proper building permits have been issued, certificates of occupancy have been issued, that there are no open permits, because if you bought a property with an open permit, the town could theoretically come in later and make you pay for repairing it. It includes a review of zoning, health department if there are septic or private well on the property. It's a review of the municipal departments of the town to make sure that there are no problems in those departments. And your attorney will discuss the results of both the title search and the municipal search with you, go over any issues, and discuss, if there are issues, discuss how to resolve them with you. The mortgage contingency is probably the most troublesome situation, because you have put down as much as 10% of the purchase price on the contract, and you have the right to obtain your mortgage and to terminate the transaction if you don't get your mortgage. But it has to be carefully handled, because if you miss the date on which you have to notify the seller that you didn't get your mortgage, you could potentially lose your deposit. What the contracts, and they all say the same thing, what the contract says is if you don't notify the seller, the contingency drops out, and you have an obligation to buy the property even though you don't have a mortgage. Now, for most people, that's not going to work. So they're now in default of the contract, and the contract further says that the deposit is, you can't use the word penalty, but it's what's called in the legalese liquidated damages, which means that they are going to claim to hold it because you've defaulted on the contracts. So you need to stay very closely in touch with your lawyer about those dates, okay? You also need to be careful about you will get something from your lender that says it's a commitment. You need to be very careful about looking that through, because even though it says commitment, it may have conditions, it will have conditions in it, and we need to review those to make sure that those are things that can be met. If it's not done timely, we can request extensions, but it needs to, there's generally a lot of money at stake, and you need to make sure that that's done properly. So now we're getting ready. Now you have your mortgage. The lender says you're what's called clear to close, which means they're ready to fund it. We set up a date for closing, and then things pick up really. There's a lot going on in the week before the closing date. You will be, well, under federal law, you are required to be given what is known as a closing disclosure. A closing disclosure is a government form. It goes on for way too many pages, but basically what it discloses is everything that has to do financially with the transaction. The purchase price, the deposit, the adjustments. For instance, if there's oil on the I'll talk about real estate taxes get adjusted so that the seller pays up until the time of the closing and the buyer pays from the date of the closing on. But since most taxes are collected on a fiscal year basis by the town, let's take Bridgeport, every 6 months, if you close in the middle of the 6 months, they will have been paid by the seller for the period that ends 3 months after you close. So you are going to pay back the seller for those 3 months, okay? We adjust oil, we adjust water. All those things get done, and those get put into the closing disclosure. Some of those numbers come from the seller's attorney, some come from the buyer's attorney. The lender has a group, all the numbers that Beth was mentioning, those go into the closing disclosure. And bottom line, you come up with a cash to close number, and that's the amount of money that the buyer has to provide for the closing. It is always a horse race at the end. They have to give you those numbers 3 days prior to closing, but they may not be the final numbers. They'll be very close, but they may not be the final numbers. So you need to stay in touch with your lawyer. Your lawyer's going to say to you, we're closing Tuesday. I need $175,223.86. And that's really the way it works out, because all these numbers just have pennies involved and odd dollars and so on. That's the bottom line. He's going to ask you, he or she's going to ask you for that money, less, of course, the mortgage amount. And there are generally in today's world two ways to do that. Either you wire that bottom line number, that cash to close number, to your attorney's escrow account, and he cuts all the checks, or you may be asked to provide bank checks, but if you are, they're going to have to be made out in to a number of different parties. You're going to be, one check will go to pay off the seller's mortgage, because that's how we ensure that it gets paid off. Another check may go to pay off the balance that's owed to the seller, and that'll be made payable to, usually, to the seller's attorney. It gets complicated, and it gets done last minute. And there's really very little way around that. I think I've probably run over my time already. Two things. Going back to the offer, whatever offer document you sign, please, please, please make sure it has an attorney contingency, attorney review provision in it, so that you can talk to your lawyer and get the benefit. All these forms are different. None of them, from a buyer's attorney's point of view, none of them protect you completely the way we would like them to. We would like the opportunity to address those issues. Second thing, at the end of the day, if you're wiring money to your attorney, there is tremendous wire fraud out there today. They are targeting lawyers' escrow accounts. It's a nightmare. I get 2 or 3 bulletins a week about wire fraud. Your attorney, if you're wiring to your attorney, please, please, please follow their instructions to the letter. You will be asked to verify the instructions that you are given by calling the office of your attorney, not at the number that's in the instructions, but the number you've used before, so you know it's the right one. Please follow those instructions, because there are people out there who want to take your money. Okay? I will just...
Thank you, Andy. Now we have the home inspection. Bob Camarda.
Good afternoon, ladies and gentlemen. So you're buying a house, and you're getting to the point where you made a contract. Now, hopefully, you have an inspection contingency. When you get that, you usually have about 5 days to complete your inspection. So it comes up fast. You have to find someone fast. So it might be a good idea to do your homework up front so that you can have someone kind of on deck. And we'll talk about how to choose a home inspector. But first, what is a home inspection? Well, basically, it is a visual inspection of the readily accessible areas and components of the house, followed by a written report. The areas covered are really everything from the top down. So your roof, chimney, the walls, windows, foundation, inside the attic, the components in the attic, including the ventilation systems, your insulation, and we look for visual mold or any other clues that tell us that the roof and attic aren't ventilating properly. The interior of the house, the walls, bathrooms, kitchens, and then your heating systems, cooling, plumbing, electrical, and garage, and so forth. Permits are important. Andy touched on that, and I would tell all my clients, check the town for open permits, especially with older houses. Many of the older houses have been renovated, not only once, but maybe multiple times. Have they all been permitted? Well, the towns should keep that information, and that's public information. You can go to the town and request it. If you're buying a house, those permits hopefully are all closed. Any open permits, Andy touched on that, could wind up costing you in the end. So what things aren't included in a typical home inspection are radon testing, asbestos testing, termite inspections, checking for underground oil tanks. But those are things that hopefully your inspector can guide you with or through. For example, radon testing, we can do that, but it's over and above a home inspection. What is radon? Radon is a Class A carcinogen. It's a gas that comes up out of the ground and is present in every house I've ever inspected, every house that I've ever tested, put it that way. So according to the Surgeon General, radon is the second leading cause of lung cancer in the United States. So it's something that I think is very important and something you should consider if you're buying a house, especially with a usable basement that you're going to be spending time in. So have that done. The pest inspection will include not only termites, but carpenter ants, bees, mice, and so forth. I do those, but I also actually bring somebody in to do that. An exterminator, I think he does a really good job. But that's something you should consider as well. Picking a home inspector. First of all, the state has licensing, so any home inspector that you're going to deal with should be licensed. Maybe insurance too. Should they be insured? Yes. Experience, I think, is probably the biggest factor that I would use in selecting a home inspector. The more experience, I think, the better inspection they'll provide. Having done over 5,000 inspections, I think I've seen a lot and understand houses just when I walk into them. Anyway, that's important.
Just wanted to tell you, Bob did 3 or 4 of my inspection in 1 year and failed homes. And it was important to me to us, because it would have, if we bought that house, we would have been in for a lot of expenses.
So that's another consideration when you're thinking, do I really need a home inspection? Well, you're always going to be getting a surprise at some point in time when you own a house. You live in the house for a few months, all of a sudden water in the basement, or the water heater doesn't work anymore. And a home inspection isn't going to guarantee that everything's going to go perfectly, but it will minimize the surprises later on down the road, and hopefully, those account for expenses that you're not going to have to pay for. So there are specialty areas too that some home inspectors are better than others with. For example, if you're buying an older house, you'd want someone who's experienced with antique homes. They are more complex, they take longer to inspect, and actually I charge more to do them because of all that. All the environmental concerns too. Underground oil tanks, very important. They are pretty present in homes still today. We find underground oil tanks or evidence of them from the inside of the house, but you'd want to make sure that they're either removed or properly abandoned. If they leak and they contaminate the area of your soil, there's really no law against that, but it will be very hard, in fact, probably impossible for you to sell the house with contamination in the ground. The only time it gets legal is if that contamination is spoiling somebody's water supply. But in this area, Bridgeport, or the areas that I inspect, usually not too many wells. So water supplies are kind of off the table. we also want to let you know that you can have the water tested. And again, without a well, you'd only really want to test for lead. Lead pipes would be more applicable to homes built prior to '88. But there's going to be lead in the pipe solder as far back as I know. So there's always going to be some lead in the solder in older homes. Lead pipes I don't find too frequently, but lead we find in water mostly in the older homes, the antiques. Thermography is another method of seeing a house. A thermal imaging camera can see differences in temperature, and that could tell us if there's moisture in a wall or overheating with wiring. So that's something you should ask about if your inspector offers that. Sorry. Prices of home inspections range from $500 to $1,500, depending on size and age, basically. I think I ran out of things to say, so does anybody have any questions?
Now we'll go to our realtors. You have a question?
Yes, I had a question from someone in the group that couldn't make it over here. They wanted to know, do you choose your own attorney or is it chosen for you?
We are in an attorney state, so you are actually, by law, allowed to choose your own attorney.
Okay, great.
The bank may suggest some attorneys that they have, and they have their fees.
Okay.
Yes, but you are legally allowed to use your own attorney.
Okay, and my question is foundation checks something we would ask for you to do, or is that standard?
Foundation checks?
Yeah, it would be standard. However, in this state, there've been, as you probably heard, bad concrete and a lot of cracked foundations. There are also sinking foundations in parts of Fairfield County, but they're not very prevalent. We've seen one sinking foundation and probably no cracked foundations.
Okay, thank you.
But it's something to be concerned about.
Matt.
Good afternoon. Again, I'm Matthew Langston. I'm a real estate broker. My name of my company is Sale State Property Group, and I'm located in Stratford. I'm going to be talking about the different properties that you can purchase. Of course, you have your single-family homes, you have your multi-family homes, you have condos, and you have co-ops. They all can be owner-occupied. You can do single-family, multi-families, and condominiums as investment. Co-ops are the only property that are exclusive owner-occupied. You cannot do investment properties on a co-op. Let's see. So the difference if you're a first-time home buyer, definitely want to talk to your real estate agent or broker regarding what property is best for you. You know, a lot of people hear that they want to be a landlord and want to own investment property. Have a conversation with them. They can tell you some of the things, the challenges of owning a single family or owning an investment property. Does it fit you? Just because your friend or a family member has a multifamily as an investment, it may not be right for you. And also your mortgage professional, they're going to also tell you what property that is best based on your income for you to purchase. Let's see. and one of the advantages of buying a multifamily, you do get a chance, depending on your income, your DTI, that rental income, that potential income can help you buy more house. So that's one of the biggest advantages in buying a multifamily house. So depending on what that one of the units offers, it helps with your debt to income ratio. So it allows you to buy a bigger house. I think that's pretty
I'll
much.
just say something about that. Okay, so to use the income of an investment, like say two-family, you want to use the second income as part of your income. There has to be a transfer. There must be a renter there right now. And if you're charging, or if the rent is $1,000, we don't use $1,000 added to your income. Some banks use 70%. Our bank uses 75%. And that offsets the expenses that you have to have, and you have to have renter's income. So don't think that because there's a rent of $1,000 or there's $12,000 added to my income. No, we take 75% if it's First County Bank, and generally across the board, lenders will use 70%. Some programs, they can't use that income unless you have history of renting, of managing properties or renting properties. So you need to be very careful with that. So anyway, we have Ayo. Shall we do exercises?
I've been using my acting voice this whole time. Sorry. Did y'all? Okay, good. Good. So the thing that you have to just know is that it's a long process, right? It's not a quick sprint. So you just have to take your time, make sure you have your documents. It makes my life and everybody else's life appear when you respond to emails promptly, if you return the documents that are requested, because once it gets going, it gets going. And you don't want to be chasing the train as it's leaving the station. You want to definitely find somebody who is a good fit for your personality. That doesn't mean that you guys have to be best friends, but you do need to be able to respect the information that they're giving you, and you need to be able to do what they're instructing you to do. Before any of these people really getting involved, except maybe Beth, I'm there with you, Matthew's there with you, Rochelle, Vera. We are the ones that you're talking to more than likely first, and then we might send you to Beth, or you already started with Beth. But the reality is that it may not always be smooth, but just know that as your realtor, we have a lot at stake, because we don't get paid until the closing table. These people get paid along the way, maybe HDF, right? They get paid through fees, along the way.
Get paid either.
See, okay, yeah, that's
we don't
true.
get paid until we're closing.
Right.
Yeah.
So we have a lot of invested energy into. We have the gas, We have researching. We just don't send you listings. We're asking you to fill out a questionnaire to find out what it is that you really want. Maybe you do not have the ability to purchase right now, even though you think you do. And you might have to wait 6 months, a year, and work to build up your credit and all these other things. But it is not impossible. And sometimes we'll put you on a little search where the system is sending you leads as it goes along. I don't have my clicker. Can you go to the next one? Okay, so this is a roadmap, a home buyer's roadmap, and I'm happy to share this with you. Takes you through the whole cycle of starting and meeting with a real estate professional all the way to closing. And you'll see the place where, oh, thank you, all the people on the panel are coming into this circle here. It could happen in 30 days. It could happen in 6 months to a year. It really depends. Each person is different. But what you have to just remember is to keep going. I was a first-time home buyer. I didn't have the luxury of all this information that you're getting. I went to visit my aunt who lived in Bridgeport, and she kind of snuck it on me and my mother to go house hunting. We saw the first place, fell in love with it, and then purchased it with no plan, nothing. We had to pay private mortgage insurance. We had to do all these things, catching up, not educated. We weren't educated as you guys are educating yourselves now, and continue to do that. I know everybody has seen all the shows on HGTV. How many have you seen? Yep. That's not reality, okay? That's not how it works. Those are cut together. They say they're reality, but they're scripted shows. This will be reality. You'll learn, but what you will learn and come out with is a property, hopefully, that will appreciate, and the equity that it appreciates with, you'll be able to either put your kid through college, pay tuition, start a new business, and build generational wealth. And that's what you want to do, and that's what we're here to do. Next slide. I can send this to anybody who wants. And if you can get that code, that will take you to my website, and you can explore listings. You can sign up for a newsletter, sign up for keeping in touch with me. I have a digital magazine I can send you as well. And I look forward to hearing that you have purchased your first home, or your multifamily, or your second property, your vacation home. If you have that, please let me know, and I will gladly accept your invitation to attend and go to your weekend home. But as Elizabeth was saying, there are 4 brokers within the church. We will all be happy to help you, or at least give you some advice along the way. And I just wish you all the best on your home search journey.
Thank you, guys, and thank you for staying. I know we extended a little bit, but I hope that we were able to give you some guidance to the process. Don't give up, like what she was saying. Don't give up. I happen to be a very patient person. My husband and my colleagues will tell you, I work very well with people trying to fix them or get them prepared to be home buyers. So, we have business cards over there. Please stop by and those giveaways. Call on anybody. You have a question?
I do have a question. I
Sure.
thought you guys were going to address LLCs. I own a home and I'm interested in purchasing another home, but I wanted to find out more.
The banks don't like to close an LLC, but our bank will allow you to close under your name and then after switch it to an LLC. But lenders don't like to close in an LLC.
Okay. So can
Yeah.
we talk about that afterwards?
Yeah, sure.
All right.
Yeah, sure.
So this question may be for everyone, but how can you differentiate the process in terms of the difference between a property versus land?
Property
So
versus...
purchasing property versus purchasing land.
Banks don't like to lend with land on... banks don't like to lend on land. It used to be they did lend on land, but they don't right now. So they want a fixture standing on that piece of land. So a lot of the people will buy a tear down, so you can actually get a loan against that property, but the house has to actually pass the appraisal. And if there's black mold or there's some safety issues, the bank may not lend you because the house is derelict. Okay, so just be careful.
Is the question whether, well, whether, I don't know how to do this thing, whether you're thinking about buying a piece of land and building, is that what you're talking about? Or just buying raw land? To build. Yeah, that's a whole different kettle of fish.
Another way to do that is, which is kind of hard, is you have to buy the land first, and then you come to our bank or any other bank that does construction loans. And when we do a construction loan, we can pay part of the land, 80% of the land. But you still have to outlay the money, buy the land first, yes.
Usually the bank wants to see the land outright first.
Yeah. Question?
Hi, my question is about pre-approvals. So if one spouse is pre-approved for like 300,000 and another spouse is approved for 100,000, is there an option for that to be combined?
Yes.
Okay.
Yes, you have to apply together. Or whoever you got the pre-approval from, they can combine those two loans. Like, for example, I for some reason, I had a client met one of my other clients, and they decided that they would buy a house together. How they met each other, I don't know. I wasn't the matchmaker there. So I had both applications, and what I did is I just combined them both and wrote a pre-approval for both of them. I thought I had a math teacher here because I had one of the clients ask me that because CHAFA had a benefit for a math teacher and I think a special eds teacher. So the clients actually said, well, now because she's a math teacher and I'm a special ed teacher, do I double my benefit? No. If you're asking that question, no. Go ahead.
Hello, I just want to thank you for your time. I had a question for the help. I wanted to know more like about the student. You didn't really go over like the student part. That's probably it.
Yes, so you're talking about student loans and how that affects how much you can afford? Or
not a student loan for school, but like, I don't know if there's something for like you just got out of school and then you want to buy a house or.
Okay. Yes. Well, you know, yes. Right. So one of the things is that we require that you have 2 years of stable employment within the same occupation. But if you just graduated and you are working in your field, then the time that you were in school, it counts towards that timing. Now, the rest have also to align the credit, but yes, you can try. And, you know, I always tell clients, you know, it's best to submit their paperwork. You're only paying for the credit report, and we can look at your situation and guide you. But that, particularly about that you just came out of college, you are working in your field, the time that you were in college, it counts. So that is not going to prevent you. We have to look at the rest as well. Mm-hmm.
The same with us, okay? So that's HDF, and we also have other programs. We have students that come out of college. Some of them are even in college. So we consider your years in college as part of work. But you do have to have at least, for Fannie Mae and Freddie, the Fannie programs, you have to have at least 1 month pay stub and a full-time job. You can't have a part-time job. You have to have a full-time job, an offer, and 1 month pay stub. Does that answer your question?
Yes, but I wanted to know as well is like, does it count if you were like a part-time or you have to be full-time in school?
Are you a part-time in school?
Yeah.
How many hours part-time? You can't have like just 2 courses and be considered a student.
Like 3 classes, I guess.
Are you working?
Yeah.
Yeah, so then that means to say your work accounts more. If you're asking if there are student discounts, some programs do offer student discounts.
So you have to be like a full-time student to be considered for the finish school full-time and then working?
Is your work part-time or full-time?
Part-time.
And how long have you been there?
Not long.
Okay, so if It depends on how many credits you have, and I have to actually get back to you. And what I can do is give me your name and your phone number. I will look it up and then get back to you. That is a more detailed underwriting, and I want to look at the programs that our bank offers, or even the programs offered in the state, and see what they offer. So I need to know really, and you need to tell me how many credits are you taking each year
All right.
or each semester. Okay?
All right, thank you.
Go ahead. Ayo?
I know we're talking about home buying, but if anybody's also interested in starting a career in real estate and you have questions, please see me or anybody, because it really is a valuable career to have that you can build for the future, and you can do it till you're near your grave.
Good evening, and I thank you all for coming in today. It was very informative. My question is for the credit score guy, because you know what? Before you look into buy a house, you got to get this in order. So let's say you have a debt, right? You have credit cards debt. Is it better for you to find a way to pay it off instead of you trying to get card that offer credit balances with, special financing? So what's better?
Every situation is unique and different. So in general, if you have high credit card debt and you open up another credit card and you transfer it, there could be some financial benefit there, but you're going to take it for the inquiry and lower the average of your credit file. So you might be hurting your credit scores, but helping yourself financially. So that's a very specific question, and that's something that we'll talk offline to see exactly what the situation is, to see what makes the most sense. Now, if you're talking about what I was mentioning about earlier about with collections, like if the accounts have already gone derogatory, then there's a whole nother thing about making sure they get paid properly so that you're financially protected, but we can actually clean up the credit as well.
All right, thank you. But they're not in collection, but
They're just in good standing. You just want to
try to find a way, like, with the finance, some of them are higher than the other.
Sure.
So,
and going to a bank and trying to get a loan could work. But again, when you do that, although you lower your debt utilization, if you took out an installment loan, you'd have to qualify for that. And then you'd have that inquiry and that new account on your credit, and that would lower your credit initially. So there's a lot of back and forth, and that's why I say if you're looking at wanting to do something, look at it now. So in case you do need to make those adjustments, you have a 6 or 12-month window ahead of you for things to catch up and be in a better standing.
Thank you.
And actually, that's a very good point. It's really best to get yourself prepared to make your life a little easier if you're thinking of buying a house. So don't make decisions yourself. Talk to an expert. Call Stephen. Call me, and I can look at your credit, and then I'll tell you, look, you got to call Stephen. Because sometimes I have clients that have money or come into money, and they decide to pay their debt, right? It lowers their credit score for some reason because they paid and closed it. And then when they come to me, I said, you're selling the house. Why would you need to pay the mortgage down to zero? Now you're short of a down payment. You could have had a better rate if you put down more payment on the house that you're going to buy. So each situation is different. So before you do anything, ask a professional.
Just yesterday, I had a discussion with a colleague that has to do with purchasing a property by an LLC. 3 questions came up. 1, the likelihood of a bank lending to an LLC to purchase real estate. The second question is, does the principal, does the owner of the LLC, does a credit of that person have anything to do with the loan itself? That's 2 questions of the 3 that came.
You said 3, so I was waiting for the third. The LLC, banks don't like to close with I think as a lady asked that question.
They do not like. I remember you saying that, but does it mean that banks do not? Or they just prefer not to?
They do not lend to LLC.
They do not lend to LLC.
Okay, and the LLC, you're going to be the owner, and even if a bank does allow you to close in an LLC, I don't know of any bank that will close unless my husband knows, because he does have a lot of closings.
Gee, I've said this before. My wife is right. They don't. It is not. It is
sure
not
now?
common for most banks to close in an LLC unless you're a builder or a developer, and that's your business.
And that's actually a different kind of loan.
What you can do.
One of the companies I'm affiliated with is a home improvement company, so we do buildings.
That might impact their ability. So I've seen banks, excuse me, I've seen banks insist that properties be deeded, quitclaimed out of the LLC, the mortgage put on, and then put back into the LLC.
What if there's a personal guarantee for the repayment of the loan?
I'm sorry?
What if there's a personal guarantee for the repayment of a loan?
Well, you're getting into really some tax issues that you really need specific advice on. That may create a taxable event.
So the short answer is not likely that the banks would lend to the LLC.
The short answer, I think, is that most banks that we deal with on a regular basis are going to be very skeptical about lending to an LLC, and you're more than likely not going to be able to do that.
Okay.
And you also asked who is actually about who's responsible for the loan if the credit of the owner of the LLC.
Well, the second question was predicated on the answer to the first.
Yeah.
So since the bank is not going to lend to the LLC, then I guess the second question is not quite relevant.
Yeah. Okay.
The third question, however, is, and I think somebody alluded to that, the projected income of the property. Let's say you're buying an income-generating property. Are you saying that the projected income, let's say there is no tenant in the property, would the bank consider the projected income, or to what extent?
There's got to be a tenant, whether they're occupying it or you have a signed lease, because we can't use income that has not been received or projected. So if, let's say, for example, you're buying a 4-unit apartment and two of them have a renter, and the third one, you might as well say, well, it's projected that I will also get $1,500, but you don't have a tenant. So there is no income. So if you cannot receive the income from the time you actually transfer title to you, the bank therefore cannot actually use that income. So what a lot of my clients do is that they get some kind of a lease, a security deposit, and the first month's rent that will start post-closing. Once you have that, then I can use that as income because you have now received a security deposit and an advanced rent on that 1 unit, and you have a lease for 1 year.
Okay, just before I take my seat, very often you're purchasing a property and there's a tenant there that is not the best of tenants. And very often the question comes up, do you get rid of that tenant before purchasing the property, or do you purchase a property with the tenant? Because very often you're buying a property, you prefer maybe not wanting to buy the property with a tenant that you're not very sure is going to be paying you timely. And so that question usually comes up.
Well, if you don't own the property yet, you're not the landlord, so I kind of find it hard that you will be able to evict that tenant while you don't own the property right now.
If it doesn't impact your financing, okay, and you don't want the tenant there,
yes,
you should absolutely, in fact, that was in my notes and I skipped over it, you should absolutely insist that the tenant be out of the property before you close. Because getting a tenant out of a property in Connecticut is not an easy thing, even if they haven't been paying the rent.
That's a scenario. It is not that you'd want to evict or try to evict the tenant. It could be that they are no longer within the contract, the rental contract previous to you. So you want to ask the question, or you often ask the question, should I renew the contract, or should I consider renewing the contract, or ask the seller to renew the contract to ensure that the tenant is there when you're buying the property, or should you ask the previous owner to terminate the contract or to terminate the arrangement before you go into it? It sounds as though you're suggesting that we're better off if there's a tenant.
From my experience as a realtor, many times those situations, the tenant is already on a month-to-month. The seller has already in advance not renewed their lease, and they're month to month, knowing that the property will be sold, so that the new purchaser will be able to give 30 days notice after the closing or before the closing, the actual date, to have that person leave.
Okay. But then it suggests that if the person leaves before you sign the contract, then the income is no longer a factor. Is that correct?
If it's month to month, it might, depending on how it's written, it may not be valid anymore.
Okay.
It has to be a continuous income. Just like your employment, you can't have an agreement with a company that you're month to month. You have to be a full-time employee for us to actually use that whole income. Otherwise, you have to have 2 years history of income for us to use that, because you may be considered part-time or self-employed.
I see. Thank you so much.
You're
Thanks,
welcome.
I just wanted to comment really quickly that this is where income and underwriting guidelines differ depending on the lender. We do not require the actual unit to be occupied. We will require, like I said, that we do require anything that you are buying to be owner occupied, which means if you're buying a 3-unit or a 2-unit property, you will have to occupy one of those units, and we do require you to occupy the larger of the units. But we will look at comps from the appraiser and go off of that.
So if you're buying a 2-family and you live in one side,
Correct.
the projected income for the second side will be a factor.
Correct.
Qualifying you in terms of income.
Yes.
Yes. Sir, but just remember, HDF is for first-time home buyers.
Right.
Yes. Okay.
Yes.
So I want to jump in here as the convener. I know it is getting late, which is good. Oh, this camera's trying to find me. Be a good broadcast person. I just want to say that some of the different things that we're talking about now, we can explore over the course of the next year, having more targeted workshops about different aspects of this process. Because this is geared towards residential. We're kind of teetering now on commercial real estate, which has a whole other level of language and strategies and all of that type of stuff, which Andy sits in both of those worlds as an attorney. So some of those things are commercial strategies. But I think this is good. I do know that it's getting late. We got childcare folks in the back, and they probably want to give your kids back to you. Is there anything else, Beth? Can we give a round of applause for our panel? Look, you're getting a standing ovation. Look at that. So as they mentioned, I'm sure they'll hang around for a few minutes. So if you have any more specific questions, you can go reach out to them. Was this good? Was this a good model, good approach? All right, well, we can explore some things in the future. May God bless you and keep you as you travel from here to there. May he give you wisdom, insight, revelation concerning the strategies that you need for your home, your house, your property, and may he be glorified in the decisions that you make. Lord, bless each and every one of these panelists and their businesses and their efforts. May they prosper for what they've poured into our community today. In Jesus' name, amen. God bless you. Thank you, guys.